Good afternoon, viewers. Welcome back again for our discussion on consolidated statement of financial position. An example that I am discussing on a topic by topic. Today, an example I would like to pick is goodwill calculation along with the pre-acquisition profits. Now, in order to do that, let's look into this now. Now, here, based on the example what is been given, now, some information we need to take it through from the question. Now, the share capital of the subsidiary, if you see the question here, is 50,000, and the investment is 80,000. Also, at the date of acquisition, the return earning at the date of acquisition is 10,000. This is at acquisition. This information is from the question. As well, return earnings on balance sheet date. Return earning on balance sheet date is 30,000. This much information available, which I have jot down into the group structure. Now, the second working or second step is calculating goodwill. Now, let's see how to calculate goodwill. Working number 2. Working number 2, calculation of goodwill. As we know, this we have to do it according to IFRS 3 revised. As we know, this IFRS 3 revised requires, when calculating goodwill, to adopt a given format, which we need to compare the total purchase consideration cost and any non-controlling interest fair value, and that has to be compared along with the net asset acquired of the subsidiary at the date of acquisition. Therefore, purchase consideration available in the group structure. If you see here, this is the purchase consideration. So that I will take it at this point. 80,000. And we clearly understand that the total number of shares acquired, the shares acquired is 50,000 shares. The 50,000 shares is the total number of shares of the subsidiary. That means the acquisition is 100%. So here we will not have NCI. NCI will become 0. So total we are having 80,000 minus fair value of net assets at the date of acquisition of the subsidiary. Now here, the net assets comprises the share capital of the subsidiary, which is, you can clearly see, which is 50,000. We will take that. As well, we also have another element of net asset of the subsidiary, which the return earning available at the date of acquisition. The return earnings available at the date of acquisition is 10,000. Now we take the total of these two, that will amount to 60,000. So you subtract this, then you arrive the goodwill. The goodwill is then 20,000. Next working number 3. Working number 3 will be consolidated return earnings. The consolidated return earning will comprise the parent company, that is, what's the name of the parent company? Singh company. Singh and the subsidiary company Wing. As per question, now let's find out what are the return earnings as per question. Now, if you see the return earning of the parent company, that gives 55,000. And if you see the return earning of the subsidiary company, that gives 30,000. Then from this, we then have to subtract pre-acquisition profits. That is 10,000 as per question. So you subtract that, then you get 20,000. This is known as post-acquisition return earnings. We then have to transfer the group portion to the parent company. Transfer to group. And we know that at this example, the acquisition is 100%. Therefore, we transfer complete 20,000 return earnings to the parent. Yeah. So this becomes 0 and this becomes 75,000. And as we know that there's no non-controlling interest, and we then have to find out, do we have any other workings or adjustments before we prepare the statement of financial position for the consolidated situation. There is no much other adjustments, so we could directly prepare the statement of financial position. Consolidated statement of financial position. Assets, we should follow the same format as per the question. Assets, which has non-current assets, then what we find there under non-current assets, for the parent company non-current asset, nothing but investment. So investment which has been fully utilized, so there is no non-current assets for parent. And for the subsidiary, there is no non-current asset as well. So therefore, this will be 0. Current assets. Under current assets, what we have in the parent company, let's find out. It's straightforward. We have 50,000 for the parent, and subsidiary, let's find out how much. Subsidiary current assets 80,000. So the total will be 130. So now we take this total here, 130,000. Prior to that, there is one additional item that we have to incorporate here, goodwill, which we have calculated, 20,000. So now we can take the total, 150. So this 150 will comprise about share capital of the parent, equity plus liability. Share capital of the parent only, how much? Let's find out. The parent company share capital is 75,000. And the consolidated return earning as per the working, if you see here, we can easily find out that amount is 75,000. So now we take this total and that total comes to 150. Now you can easily understand. Now the total on the asset side 150, total on the equity and liability side 150. So the balance sheet agrees. And this is how we conclude this question. Before I conclude this video, I would like to give a little more elaboration as to how we approach pre-acquisition profits when come to consolidated statement of financial position. Pre-acquisition reserves. Generally, the question will give the reserves, mainly return earnings or any other reserves, at the date of balance sheet. They will be giving at the date of balance sheet. That will be given. That's how the question will. This you can find it in the balance sheet or in the statement of financial position. What is the total of the pre-acquisition or the total reserves, not the pre-acquisition reserve. Total reserves will be available in the statement of financial position. But on the other hand, the paragraph information in introduction paragraph or additional information paragraph will specify what was the reserves either at the date of acquisition or prior to that. This is known as reserves at acquisition. Now that will be given as an additional information. Once you know that, so what you then have to do is, in preparing your consolidated statement of financial position, first in part of calculating goodwill, you must be using any reserves available prior to acquisition. So from the total reserves available in the balance sheet, you then have to subtract this. And here, what is important to note that later that you have to analyze the group portion and NCI portion. So once we subtract this from the total reserves available at the balance sheet date, then we subtracting the reserves at the balance sheet date or prior to acquisition, subtracting the reserves prior to, at the date of acquisition, the remaining is known as post acquisition. Now if you see this diagram here, what I am drawing, and let's say this is the incorporation date. Incorporation date of subsidiary. Incorporation date of the subsidiary. This is the acquisition date of subsidiary by parent. And this is the balance sheet date of subsidiary. Now, this period is known as pre-acquisition period. And this period is known as post-acquisition period. Now remember, when computing the goodwill, we have to use, in calculating the net assets of the subsidiary which we have acquired, we should include all the reserves available at the date of acquisition. So when calculating goodwill, so what will you do? You will take this portion here. You will take that portion here and that reserves will be brought from the total reserves available on the balance sheet. On the other hand, what will happen with this? This one is known as the post acquisition, and that we have to use it in calculating consolidated return earnings or reserves. So therefore, we have to bring it that here. That's how the analysis will continue. However, thank you for watching this video, and please do share, subscribe and like my videos in order to get more discussions on financial accounting and management accounting topics. Thank you for watching.